Okay, so let's go over the S&P futures. It's January 30th, and we're still working with the January monthly candle still. What you see right now on my screen is the S&P futures. Basically, the 52-week low here at 2,174 back at 2020, and then a big V-shaped recovery back above the red line, which is the 200-day moving average, and then just trend for pretty much 2 years, and now we're pulling back after making a 52-week high. The S&P has pulled back and is retesting that 200-day moving average. What you can see here, if it's your first time here watching this video, what you want to do is you want to plot your moving averages, because moving averages help you identify trends, and it helps you identify extensions. They're very useful, and what we use here are these green dots, which represent the 6-day moving average. Okay, and we use the orange as the 21, the cyan as the 8. We use the white as the 50, the green here as the 100-day moving average, and the red as the 200-day moving average. Looking into the recent price action of the S&P from its 52-week high at 4,808.25, it's sharply pulled back and pretty much retested. Not only did it did an ET, which is basically a crack through that 8-day straight to the 21, it consolidated and moved all the way down to the 100-day moving average. So in that, if we take that impulsive wave and assume that that's wave 1, okay, using Elliott wave, a general approach to Elliott wave, just wave 135, that will assume that that impulsive wave here is representing wave 1. If that's wave 1, then the bounce that we see here in this candle with the long-legged doji, where buyers stepped in, proceeded to move the price back above the 6 and the 8. Okay, so that's a rip your face off rally, and we will assume wave 2. And then finally, wave 2, we get the wave 3 flush, which is an 11% correction or move to the downside, overshooting the 200-day moving average, and then now we're in this choppy range. So if that is the end of wave 3, then we are in the process of putting in a wave 4 and or consolidating. It looks like it's more consolidation. Now, if we are in a wave 4, which we'll be able to tell when the futures opens, then wave 4 could bounce all the way up as high as 4,573. And the reason being is that if you're taking the wave 135 course, let's take a look. Where is it? The third wave. Wave 1 is the impulsive move, right? It's the fastest and hardest to catch, because you're catching that move off of a 52-week high or falling knife, and then it's pulled back to wave 2. That's the red area, red line here, and then 3 pushes is the breakout through the top of wave 1, and then you can see wave 4 in this black horizontal perforated line cannot exceed past the top of wave 1. So if this is the case, wave 1 ended here, and that's where the 21-day moving average coincides with the level 4,564. Then if you make sense out of this using some of the strategies and concepts I've taught, then you can clearly see that there is a potential where the S&P can move toward the 21-day moving average, since it's pushed right through the 6 and the 8, setting up for an ET. Now, that ET setup, it doesn't necessarily mean that the price of S&P is going to have is going to reach up to that level to the penny, but there's a probability that it can definitely reach in stages, probably 80% up to the halfway mark, and then a 62%, 58% probability of reaching the 21-day moving average, because the moving average of the 21-day moving average is still moving lower as price moves higher. They're going to coincide at one point in time. Then after that, if this is truly a Elliott wave 135 setup, then after it reaches the 21-day moving average, then wave 5 would commence and take the S&P down to 4,011. Okay, and that's because we know that there's a gap here at 4,011. If we pull up the, let me pull up the chart here. Trading view. So here in trading view, if I plot the customizable gap finder, we can see that there's a gap right here at 4,016, 4,008. So we're in wave 1, 2, 3, 4. So we're in wave 4, and 4 will bounce, and it should not push past 4,570. So we wanna, so then the time it takes, I think from the price here, let me put on the moving averages. So the moving average of the 21-day moving average is represented in orange. So if I measure the move from here to here, that's 3.46%. That would be about, it would take about 3 to 4 days for the S&P to make a move of 3.46 if we're assuming like a 1% move average per day, right? So when Sunday opens, it's probably going to open up positive. And if it does, then we can see that there's clearly a potential for it to gravitate toward the 21 going into Monday and Tuesday. So 3 days from Sunday, Monday, and Tuesday, possibly even Wednesday, we could see a rally in the broad markets and retest that 21-day moving average and then drop all the way down to the gap. Okay, so we're not quite out of the bear market yet. We just started the bear market technically here. Okay, the bear market actually started here, but there will be bounces along the way. Okay, so wave 1, 2, 3, 4, and then 5 all the way down to that gap, and I don't know when that's going to happen. So we're not trying to catch this gap fill at 4,011. We're just anticipating the ET setup in the S&P because it's already pushed right through the 21-day the 8-day moving average, and that gives us probabilities of the market moving higher, approximately 80% up to 4,500, and then 60 to 58% up to 4,572, and then we want to be flat and not assume that it's going to break out higher and make a new 52-week high. You want to be flat or open up puts or hedge your positions, because there's going to be another flush in the market that takes it down to 4,008. Okay, I don't think all gaps in the futures, especially for the S&P futures, they get filled. Okay, so let's go ahead and take a look at some of the positions I have. So right now I have Roku, and Roku has earnings coming up pretty soon on February 17th. So that if once they confirm their earnings, I wouldn't be surprised for the Roku to start running or attempt to run. And with this pattern here, it's very similar to what we're seeing in the S&P. The S&P's got these moving averages where they have the 6, 8, and 21, which is situated above the price. So if Roku closes or pushes through 155, then there's a quick move up to 180. We have the 170 contracts. So closing off half your positions at the halfway mark at 167 and then holding the rest to see if it makes it tags at 180. That would be a fantastic move, and that would be considered wave one, in my opinion. That would be wave one, pulls back to wave two, and then wave three up to the 200-day moving, 50-day moving average of 205 by earnings. So if that's the assumption, we're seeing 205 by earnings, then I would expect the market to correct down to 4,008 after Roku has announced earnings. It's just an assumption. Tesla has been pretty wild because it's so emotionally, it's got an attachment with a lot of people's emotions because everyone's pretty much all in Tesla, which is horrible. But everyone is different. So from its 52-week high here at 12,439, it's been chopping. You can see how crazy the moves are in Tesla, especially the one here. And then it's pulled back to the 200-day moving average. They all eventually will retest the 200-day moving average. It's just the cyclical nature of the stock market. Okay, so since it's touched and retested the 200-day moving average, you can actually see that it's quite extended from the 6-day. And then if we do get that bounce, okay, and it pushes through, retests the 6 on Monday, then there could be a quick move to the halfway mark in Tesla up to 968. I don't know if it's the safest thing to assume the price of Tesla to tag the 21-day moving average, okay, which is around 1,022. It is wishful thinking. I do have the $1,000 calls, but in this situation where it's bounced off the 21 and still extended from the green dot, which is representing the 6-day moving average, there's a chance that it could push quite aggressively through the 6 to the 8 on Monday. That would represent a move of about 5%, okay, up to the 6 or 6%. And then if it makes another move that is 6%, then we've got, I would say, 12% move would take us up to 956, which is pretty much where that 100-day moving average is. So there's a lot of there's a confluence of moving averages showing negative gradient, flat gradient, and more negative gradient. But at the same time, there are mean reversion plays at the same time into a TGIF cycle. TGIF cycle generally is around 58% to 60%, assuming the price is going to move higher in a bullish direction. So if we are going to assume that with a 60% probability, then I would say Tesla's got a great shot of tagging that 100-day moving average, which is represented here in the light green line. Okay, and then assuming that it moves up to the 21 and then up to the 50, that's a little dangerous. But if you're well aware of how the TGIF works, you're pretty much out of the position by Tuesday 10:30 a.m. Eastern time. Looking at some other stocks here, Shopify, these are all beaten up stocks, and it looks like Shopify has just entered into earnings territory where its earnings are scheduled to be released on February the 16th. If we measure the pullback from the 52-week high, it's pulled back around 55%. So that's a pretty brutal pullback. And honestly, if you have all your money, your kids' money, your grandma's money, your daddy's mommy, your mommy's money in the stock, you've got to add dollar at cost average here, because this is 55% from its 52 high is very rare to see. And if it does bounce, then you can clearly from the moving average, the way that its position is almost the same way as Roku, 6, 8, and 21. So a bounce is in order if it does push through, and I would say a 22% move is possible. Okay, anything's possible, but most likely half of that move, that ET move, would be representing a 15.61% move that would take it up to $1,000. Now, up to $1,000, you definitely need to manage your risks, say closing off half your position, but it's worth a shot to hold these positions up all the way up until Tuesday. And if you don't see 1,000, then you've really got to start closing it out because it's going to probably start roll over and dump even more. Taking a look at Amazon. Amazon's got earnings, so they're probably going to see a 3-day bounce. Amazon's earnings on February 3rd. It started bouncing, and I would say it looks exactly the same thing as Shopify and Roku. So a bounce up to the midway mark of the ET would take it up to 2,970, or 3,000, and then whatever you hold up until February 3rd, there is a good chance that it could get to 3,135 before earnings, and then after earnings, you do not want to hold positions in Amazon. Okay, so unless you want to, you can hold one or two, but you don't want to hold their full position because this is a binary event and nobody knows which way it's going. But if you had to take a guess, you would guess obviously bullish, right? Because we're generally positive sentient beings. We want to stay positive, right? We don't want to hang around negative people. So you want to just stay bullish if you're if you manage your positions properly and you're holding an excess amount after managing half at 3,000 and then another half at 3,100, then whatever risk you have left in those strikes, then you just let them go worthless or see how much money it makes on the earnings announcement. Apple is had great earnings. I mean, a great earnings reaction, and it did a kicker. So a kicker is basically a red candle where the candle literally jumps over the red candle from the close and then opens up above the open here at 1,165. And now it looks like you can see Apple led the way on the ET because it did the kicker and went straight to the 21-day moving average. So what happens next with Apple? Well, I guess Apple, this is a wave one, I believe. Yeah, wave one. And believe it or not, that wave one ended here at 168, and its wave three on earnings, it pushed right through wave one, which invalidates the whole wave 135 structure. So that might be a clue that the S&P could rally back to its 52-week high. It does look like that Apple's structure, wave 135 structure, is invalidated right here, right? And Apple could keep on running higher and then maybe meet resistance at here at 1,177. Okay, and then dividends are coming out on the 4th, which generally is pretty bearish. Okay, because the put options usually benefit on days where they announce dividends, but that if you're in Apple, then you want to be careful that it is extended above the 6-day moving average. Is way up here at 170, and the 6-day moving average is way down here, $8 below. The moving average is obviously delayed, right? It's a delayed indicator, so it's probably going to move up to 165-ish. And I think if we use some candlestick analysis approach, this would be a bake-in. So I would expect maybe a flat day, maybe a Magic Mike ending up a doji on Monday, and then another pop up into 176 by Tuesday, and then a dump into February the 4th. Looking at NVIDIA had a massive bounce off its 200-day moving average. That's the red line. And it has the same setup as Shopify, Amazon, and Roku, where it could push through the 8-day moving average at 232. 232 pushes it up into the 21-day moving average at 261. A conservative approach would just be taking it half at the 247, managing positions half here at 247, and then leaving the rest to run up to 262. So the common theme here is that there's a lot of stocks that have been beaten up to death, and it looks like the bulls are tapped out and the bears are full, and there's a possible ET setup in not only the ones that I'm just talking about, but pretty much everything, most of the stocks in the market that's been beaten up. Let's take a look at Netflix. Netflix has this gap here, and if it pushes through, there's no resistance up until this gap gets filled, right? So this is probably something that we want to look for, a wolf wave setup, but that's looking like it wants to, on its next earnings run, it probably wants to get back above and fill that gap at 500. That one's going to take a little time for it to move. So we went through Tesla, Nvidia, Shopify, Amazon, Roku, Boeing, let's see, LRCX. So LRCX is after earnings. It's extended below the 6, and then I guess a mean reversion. You can even see here with the 200-day moving average, it's right in the middle between the 8 and the 21. So it's giving you a clear level of resistance at 624 should LRCX bounce into a TGF cycle. Google. So Google also has earnings, and it looks like it's running on that 3-day bounce. Earnings are out on the 1st. It's Monday, so same idea. I mean, it's already moved halfway to the, that looks exactly like what LRX should be doing, right? Because that's the 200-day moving average is right in between the 21 and the 8. So there is a good chance that if the market's S&P and the Nasdaq opens higher on Sunday, then we can expect Google to bounce up to the 21-day moving average at 2,734. And then again, whatever happens after earnings, this is going to be, it could be flat, it could be up 10%, down 10%. This is a binary event, so caution. You don't want to be taking too many binary event option trades, because that's a very quick way of blowing up your account super fast. Okay, let's take a look at the Nasdaq. Actually, I haven't seen the Nasdaq, and then I'll take a look at the VIX. So the Nasdaq here looks exactly like the S&P, and it's still extended way below the 200-day moving average. So I guess it's pretty straightforward here that there looks like an ET trade up to this orange line, but halfway up to that level, I would say it would be around here at 14,919, or just maybe there is a good chance that it could retest that 15,000 level, which represents the 200-day moving average, and then it pulls back and the S&P proceeds to fill the $4,000 gap. And the VIX, so the VIX has been actually, if we look at this in a little bit more detail, it looks like it's made a double top, a higher high, but it's pulling back and trading under the 6. And believe it or not, it's trading under the 8, setting up for a move down to the 21-day moving average up to 23, and there's a gap fill at 17. So if the VIX continues to roll over and trades in the red, that's risk on. And if that's the case, then markets are going to trade higher, and then we can see a lot of the stocks that are in an ET setup fulfill the move from the 8 to the 21-day moving average. So I do have a position again in Roku, and if we use like some of these wolf waves, let's take a look at the wolf wave here. I got two positions in Roku and Tesla. And Roku is a very interesting one because it has a daily wolf wave, and that is quite exciting. We did try to catch this a couple times, but there's also a gap here at 166 right there. Okay, so if we do get this wolf wave to cooperate, then I'm looking for a quick fill at 167.03. That's the low of that candle inverted hammer, and then that would take it right exactly to half of that ET setup, where the 8 and the 21, and then whatever I manage, I'll let it run up to the 21-day moving average. And I'm not sure if it's gonna have a shot to run up to the $200 mark, because that's a 37% move in what, 17 days. It's possible, but we have to be realistic. I think 10% is in order. If we look at the 78-minute time frame, that's the time frame that I like to teach a lot when you're trading options. The 78-minute time frame, you can see a series of sell-offs in Roku, and then basing and another sell-off in Roku, and another sell-off in Roku. And it actually made I think a 52-week low at 139.47. So that's good that the low is in. And I guess, once you hit rock bottom and you go dead broke, the only thing you can, the only direction you can go now is up, whether you're dead broke with a penny or you increase it by 50 cents, you're still up. So here with Roku, it's gone down so much that it's the bears are full. Bulls are kind of looking to see if they can get in there one more time. And then technically speaking, like I said before, there's an ET set up from the 8 to the 21 with that daily wolf wave, and a bullish wolf wave that triggered here on Friday, very choppy Friday into the close, and then started to rally into the end of the day. And then I would say, look at that right here. If I move the mouse right to the apex up to this level, which coincides to where the 21-day moving average is likely to be, that's $176 by February the 1st. So there is a really good chance that our contracts for Roku could end up becoming worth, well, I bought them at $1.60, so they could be worth about $6 to $7 by Monday. Okay, and that could be motivated with the Google earnings. So if Google has good earnings, it doesn't necessarily have to blow the earnings out of the water. It just has to stay green. And if it does blow out of the water, then everything is going to go a lot higher. And like I mentioned before, Apple invalidated the wave 135 to the downside because its earnings kicked, and it invalidated wave 1. Right, it entered into wave 1 territory. So there is a probability that we do run higher, and they delay the $4,000 gap. So nothing's clear cut. It's clear as mud to me, honestly speaking. And then Tesla, if we look at it on the 70-minute time frame, there's a 70-minute TTM squeeze, which I love. And you can see the 100-day moving average right there showing you exactly where it's likely to move and not move above it. If it does move above it, then it would have the best shot of doing that before Tuesday. And relatively speaking, if you look at the measured move here, that's a 20% move. So I don't know, that's a pretty big move. And yeah, I mean, it could happen. So, I mean, I don't think you want to be holding, if you have like, say, $800 in options, and you already made it up to here with 200-300%. You definitely don't want to be, you definitely have to close something once you get there, right? So you want to if you have like 5 or 10 contracts, let's just say 5, right? And it gets up to 964. You better know how many you want to close. You can close 4 and hold 1, or you can close 3, hold 2. At that point, I'd probably close off 4 and hold 1, right? Because, I mean, that's a 13.27% move. You don't get those every day. And then another 7% move what's the probability of that happening? So be realistic on how you manage your profits. It's always about managing your profits, which is your risk, and not about hitting those targets that you do your technical analysis on. That's the most important thing to understand. Okay, so thank you very much for your time and have a great day.